Okay, so picture this, you've spent weeks, maybe even months, backtesting this amazing trading strategy. The numbers are looking phenomenal.
Yeah.
You're just crushing it in the backtest. The win rate is amazing. You're already mentally spending all these profits.
Right.
But then you launch it live, and
Yeah.
cricket's nothing. Or even worse, it blows up your account. It's
Right.
like the nightmare scenario, right? And that's what we're diving into today, how to build trading systems that actually work not just on paper, but can survive in the real world.
That's the dream, isn't it? Bridging that gap between back-tested performance and, real-time results. That's exactly what Keith Fishin gets into in his book, Building Reliable Trading Systems.
And that's our deep dive today.
That's it?
When I first started digging into these excerpts, I was really struck by this concept of tradability.
Yeah.
It seems kind of obvious, but I think it's so easy to overlook when you get excited about a new strategy.
Absolutely. It is easy to get caught up in chasing those big wins, and Fishin really brings us back down to earth, lays out these three core principles of a tradable system. Number one, you've got to have consistent profitability.
Right.
It's not about those home runs every time. It's about stacking those singles and doubles.
Right.
Making sure your average return per trade is positive.
It's like building a solid foundation brick by brick.
Exactly.
Instead of trying to build a skyscraper on, shaky ground.
Exactly. And once you've got that foundation, you need to make sure your annual returns outweigh your potential drawdowns significantly.
Right.
Basically, you need to make substantially more than you're risking each year. Otherwise, you're kind of playing this high-stakes game where the potential losses overshadow the potential gains.
Makes sense mathematically, I get that. But how do you factor in your own risk tolerance? That feels more psychological than anything. Can a system really account for that?
Yeah, and that's where Fishin's third principle comes in.
Okay.
Setting a maximum drawdown level you can actually handle emotionally.
Yeah.
Because let's be honest, even the most seasoned traders, we all feel that pang of panic when our account takes a hit.
Oh, absolutely. Been there. Just staring at the screen, questioning every decision you've ever made.
Mm-hmm.
So it's about finding that sweet spot, right? Pushing for profitability, but also sleeping soundly at night, knowing you can weather those inevitable market storms.
Precisely. And even if you nail those three principles, there's this insidious trap that can sabotage even the most promising systems.
Curve fitting.
Curve fitting, the silent killer of so many trading dreams.
Right.
I think most of us understand the concept, but what really resonated with me was Fishin's build, rebuild, and compare method.
Yes.
It's like this built-in lie detector for your strategy.
Oh, it's brilliant. Instead of just optimizing your system to perfectly fit all the historical data, you divide it into subsets.
Okay.
You build your strategy on one and test it on another that you've deliberately held back. If the performance changes dramatically, you know you've got some curve fitting lurking in the shadows. It's like holding your strategy to a higher standard, making sure it can perform on data it hasn't even seen before. His example, using moving averages across 37 commodities, really drove this point home for me.
Yeah.
Initially, it seemed profitable, but the beer assay method, build, rebuild, and compare, it exposed all the hidden curve fitting.
Yeah, it's a stark reminder that we can't just blindly trust backtests.
Right.
We need to be skeptical, challenge our assumptions, and constantly test the system, make sure they're robust, not just products of overoptimization.
Okay, so we've got this solid strategy, checks all the boxes, consistent profitability, a manageable risk, no curve fitting. But I'm wondering, how much does the market itself impact a system's reliability? Can a strategy that works for stocks also work for commodities or Forex?
That is a crucial question, and Fishin dives deep into the nuances of those different asset classes. What's fascinating is he shows how even within a single asset class, like stocks, behavior can vary dramatically across different time frames. What works on a daily chart might not translate to a weekly or monthly chart.
So it's almost like you need a different playbook for each market and time frame.
That's a great analogy.
Yeah.
He illustrates this by analyzing a basket of 100 stocks and showing how on daily bars they often exhibit counter-trend behavior.
Wait, counter-trend. So weaker stocks can outperform the strong ones on the upside.
It does, but his analysis reveals this really intriguing pattern.
Huh. Interesting.
And this contrasts sharply with commodities, which tend to trend more consistently on daily bars. He uses the example of buying strong versus weak commodities to highlight this difference.
So it's not just about understanding the asset class as a whole, it's about drilling down to those specific time frames, those subtle nuances in their behavior.
Exactly.
Like you're a detective piecing together the clues, understanding the market's personality before you can even begin to develop a system that works with it.
Absolutely. It's like speaking the language of the market, right?
Exactly. And this is where it gets really interesting for me, because now we're not just talking about these abstract concepts, we're talking about entries and exits, the heart and soul of any trading system.
Absolutely. And what I found fascinating is this concept Fitchin calls entry power. He emphasizes that some entry signals, they need time to develop, to gain momentum, before they truly become profitable.
So patience is a virtue even after you've entered the trade.
Precisely. And he analyzes various entry techniques, comparing their performance characteristics across different markets, RSI, rate of change, standard deviation breakouts, even Dongxin entries. What stands out to you?
I think what struck me is that there's no magic bullet. There's no single entry technique that reigns supreme across all markets.
Right.
It's about understanding the strengths and weaknesses of each approach and choosing the one that aligns best with, the market you're targeting.
Yeah, that's a key observation. And once you've got that entry figured out, you need to master the art of the exit. This is where things can get really tricky, right? Knowing when to take profits, cut your losses, trying to balance that fear and greed.
Oh, tell me about it. It's a roller coaster. Fitchin explores a whole array of exit strategies. Reversal signals, traditional stop losses, time-based exits, profit targets. But what really resonated with me was his emphasis on this gain-to-pain ratio.
Yes, that's a powerful concept, isn't it?
Yeah.
It's not just about maximizing profits. It's about optimizing your gains relative to the risk you're taking.
And I think that's something a lot of us overlook. We get so focused on chasing those big wins that we forget to protect ourselves from those gut-wrenching losses. Analyzing the gain-to-pain ratio, it's like finding that perfect balance between aggression and caution.
Well said. And it highlights the importance of aligning your exit strategy with your, individual risk tolerance and trading style. There's no one-size-fits-all solution.
Okay, so we've got our entries and exits dialed in. We're managing risk like pros. What's the next piece of the puzzle when it comes to building a reliable trading system?
Well, it's like we've built the engine of our trading system, but now we need to fine-tune it for peak performance.
Okay.
That's where filters come in.
Filters?
These are the tools that can help us avoid those unnecessary trades.
Right.
The ones that drain our accounts and our confidence.
Filters. They're like the secret sauce.
Yeah.
The little tweaks that can take a good system and make it great.
Absolutely.
But there are so many types of filters out there. Where do we even begin?
Fitchin breaks them down into a few key categories. Seasonal filters, volatility filters, and longer-term trend filters.
Okay.
Each one serves a different purpose, helping us align our trading with the prevailing market conditions. For example, with stocks, he demonstrates how a simple filter based on the day of the week can actually enhance profitability.
Wait, really? The day of the week can influence stock performance?
I know, it's fascinating.
That seems almost too simple.
It does, but his analysis reveals these subtle patterns in market behavior that we might miss if we're not paying attention.
So it's like these hidden variables in an experiment.
Exactly.
The ones that can skew your results if you're not careful. And this makes me think about money management, which is often touted as the, holy grail of trading success. But Fitchin seems to challenge that a bit.
He does. He argues that money management, while crucial, isn't this magical solution that can transform a losing strategy into a winning one.
Right.
It's about maximizing the potential of a solid system, not masking its flaws.
So you can't just throw money management at a bad strategy.
Exactly.
And expect it to turn things around.
Right.
You need that solid foundation first.
You need a good strategy first, absolutely.
What I found insightful was how he debunked this myth that money management is simply about position sizing.
Yeah.
He emphasizes that you need to consider factors like diversification, the serial correlation of trades, even your account size.
Yeah. It's a more holistic approach.
Right.
Looking at the entire ecosystem of your trading.
It's not just about those individual trades in isolation.
Exactly.
And this makes me think about the Kelly criterion, which is often presented as this mathematical formula for, optimal bet sizing. But Fitchin seems to have some reservations about that.
He does. He cautions against blindly applying formulas from, the gambling world to the complexities of the market. The Kelly criterion, while theoretically sound, assumes certain conditions that rarely hold true in real-world trading.
So it's another reminder that we can't just plug numbers into a formula
Right.
and expect guaranteed success.
Exactly.
We need to understand the nuances of the market we're trading and adapt our approaches accordingly.
It's about being an informed trader,
Right.
not a gambler, just blindly following systems.
Which brings us to another fascinating aspect of the book.
Yeah.
How Fishin tackles some of those pervasive trading myths.
The sacred cows.
Right, the ones everyone seems to accept as, gospel truth.
Right.
One that always stuck with me was this idea that the exit is more important than the entry.
Yeah. Interesting.
Sounds logical on the surface,
Yeah.
but Fishin kind of turns that on its head.
He does.
And he uses that fascinating example of Tom Basso's random entry system to prove his point. The system actually generated profits even though the entries were completely random.
I know, it's amazing.
It was all about the exit strategy.
Right.
It was designed to ride trends and cut losses quickly.
It's a powerful illustration of how a well-defined exit strategy can compensate for, a less than perfect entry.
So the entry doesn't matter at all.
Well, not necessarily. Fitchin argues that while the exit is crucial, a strong entry signal, one that identifies high probability trades, can often make all the difference.
It's like that initial spark that sets the whole system in motion.
I like that. It's about synergy between a powerful entry and a well-defined exit, working together to capitalize on those market movements.
Now, another myth Fishin tackles is this idea of adding to winners, which seems so intuitive. If the trade is going in your favor, why not pile on?
Right. Amplify those gains.
It's like that fear of missing out, that the train's leaving the station and you need to jump on.
Yeah.
But Fishin highlights the dangers of this approach.
He does. He explains how adding to a winning position is essentially averaging down.
Oh, okay.
Which can increase your risk and actually magnify your losses if the market turns against you.
So it's about staying disciplined, sticking to your initial position size.
Absolutely.
And letting your winners run their course
Right.
without getting greedy.
Without chasing those extra gains, yeah.
Now, one final myth I want to debunk is this notion that markets are always trending. It seems like every trading book is about riding those waves of market momentum, but Fishin seems to have a different perspective.
He does. He challenges this assumption by analyzing the ADX indicator, a common measure of trend strength.
Okay.
He shows that trendiness can actually vary significantly over time and across different markets.
Interesting.
You can't just blindly assume that a market is trending just because it's done so in the past.
So we need to be more discerning.
Yes.
Look for evidence of an actual trend.
Exactly.
And adjust our strategies accordingly.
Right. In fact, Fishin even shows how some markets, like stocks on daily timeframes, often exhibit counter-trend behavior.
Right, where those weaker stocks can outperform on the upside.
That's it.
Huh. This has been an incredible journey so far.
Yeah, it has.
Fishin's book is just packed with practical insights and challenges a lot of our deeply ingrained beliefs.
I agree.
But I'm curious to dive deeper into the specific stock and commodity strategies that he actually develops in the book.
Let's do it. There are some real gems in there.
I'm ready to unlock those secrets.
Okay.
What can you tell me about this Donchian entry technique he uses in his stock trading strategy? I've heard of Donchian channels,
Right.
but I'm not sure I fully grasp the concept.
It's actually pretty straightforward. A Donchian entry is a trend-following approach where you enter a trade when the price breaks out of a predefined range, often calculated using the highest high and lowest low over a specific period, like the past 20 bars.
So you're essentially waiting for the price to break out of its recent trading range.
Exactly.
Signaling a potential shift in momentum.
That's it.
And what's interesting is how Fishin demonstrates that even a slight adjustment to that look-back period can significantly impact the strategy's performance.
It can, yeah.
It's like fine-tuning an instrument,
Yes.
finding that perfect resonance.
That's a great way to put it.
Okay, so he's established that Donchian entry. Then he explores various exit strategies,
Right.
comparing stops, time-based exits, and profit targets.
He tests them all.
So it's not just about entering at the right time.
Right.
It's about managing the trade effectively, knowing when to get out, whether you're taking profits or cutting your losses.
It's all part of the process.
But out of all those exit strategies, what stood out to you as the most effective?
What really resonated with me was his emphasis on the gain-to-pain ratio. As a key metric for evaluating those exits, it's not just about maximizing profits in isolation. It's about optimizing your gains relative to the amount of risk you're taking.
It's about finding that sweet spot
Exactly.
where you're pushing for profitability but also protecting yourself from those huge losses.
Precisely. And by analyzing that gain-to-pain ratio across different exit strategies,
Right.
you can make more informed decisions about when to get out, balancing that profit potential with your risk tolerance.
A robust entry and exit strategy is only part of the equation, though.
Right.
Fission takes this stock system a step further by introducing filters to refine the performance even more.
Filters, yeah.
Those extra layers of protection, helping us avoid those unnecessary trades and capitalize on those high probability setups.
Absolutely.
But with all those different filter types, which ones did he find most effective for this particular stock strategy?
One that really stood out was a simple filter based on the trading day of the week.
Okay.
It might seem counterintuitive that something as arbitrary as the day of the week could influence stock performance.
Yeah.
But his analysis revealed some interesting patterns.
Huh. So certain days might be statistically more favorable.
That's what his research suggests.
Right.
And by incorporating this day-of-the-week filter, he was able to enhance profitability and reduce risk.
It's a reminder that sometimes the simplest solutions can be the most effective.
Absolutely.
Now, I'm curious how these principles translate to other markets, like commodities.
Right.
Does Fission offer a similar level of detail when it comes to developing a commodity trading strategy?
He does. He develops a separate commodity strategy alongside the stock system,
Okay.
highlighting the importance of tailoring your approach to that specific market you're trading.
What are some of the key differences between developing a system for stocks versus commodities?
Well, I imagine the volatility alone would require a different mindset, right?
Yeah, commodities can be wild.
Exactly. Fission emphasizes understanding the unique characteristics of commodities, which are often leveraged instruments.
Right.
They can experience those wild price swings.
The kind that make you sweat.
Oh, absolutely.
So risk management becomes even more crucial when you're dealing with those leveraged beasts.
It does, yeah. One technique he highlights is limiting your total open trade risk as a percentage of your account equity.
Okay.
This helps prevent you from taking on too much risk, even during periods of high volatility.
So it's like having those guardrails in place,
Exactly.
preventing you from driving off a cliff
Yes.
when the road gets bumpy.
That's a great analogy.
But what about those specific entry and exit techniques for commodities? Does he use a similar approach to his stock strategy?
There are definitely some nuances to consider. He explores different types of volatility filters for commodities,
Okay.
capitalizing on those periods of increased price movement to amplify gains.
So instead of shying away from volatility, you're embracing it.
Exactly. One filter he tests is a high volatility range filter, using both standard deviation and average true range
Okay.
to gauge that market volatility.
So you're waiting for those moments when the market is really moving.
Precisely.
Then you strike.
You ride that wave of volatility.
But it's not just about blindly entering trades
Right.
during volatile periods.
No, you still need a robust entry and exit strategy.
Right.
You need to manage that risk carefully.
Make sure those periods of high volatility don't lead to, catastrophic losses.
Exactly.
Okay, this is all incredibly fascinating.
It is.
But I want to step back for a moment.
Okay.
Revisit something Fitchin emphasizes throughout the book.
Yeah.
This importance of challenging those widely held trading beliefs.
Right. Those myths that can sabotage our success.
It's so easy to get caught up in those commonly accepted truths.
It is.
But we need to be skeptical.
Yes.
Think critically.
Absolutely.
Look for evidence.
Let's just follow the herd.
So let's debunk some more myths. One that always bothered me is this idea that the exit is always more important than the entry.
Yeah, we touched on that earlier.
Sounds illogical,
Right.
but I've always felt that a strong entry signal is equally important.
You're right. And Fission backs this up with that example of Tom Basso's random entry system.
Right.
Remember, profits despite random entries.
It was the exit strategy that made the difference.
Right. Designed to ride trends and cut losses quickly.
But I wouldn't say the entry was unimportant,
No, not at all.
just that the exit was particularly effective.
Exactly. Fitchin argues that a powerful entry signal, one that accurately identifies high probability trading opportunities,
Right.
can make all the difference.
It's like that classic yin and yang,
Yeah, I like that.
finding the perfect balance
Yes.
between those two opposing forces.
To create a harmonious whole.
Now, another myth I want to tackle is this idea of adding to winners, which, again, seems so intuitive but can be so dangerous.
Yeah, that fear of missing out
Right.
can lead us to make irrational decisions.
Piling onto a winning trade, hoping to squeeze out those extra profits.
Right, but as Fitchin explains, that can backfire spectacularly.
It can. He explains how adding to a winning position is essentially averaging down.
Yeah.
which can increase your risk exposure.
And magnify your losses if the market turns against you.
It's a reminder that discipline and risk management are crucial.
Absolutely.
Even when things are going our way.
Even when you're winning.
And speaking of market behavior, I want to address that myth that markets are always trending.
Yeah.
I know Fishin challenges this assumption head on.
He does. He analyzes the ADX indicator.
Right, that common measure of trend strength.
He shows that trendiness can vary significantly over time and across markets.
So you can't just assume a market is trending.
No.
Just because it has in the past.
You need to assess the current market conditions, look for evidence of a trend, and adjust accordingly.
In fact, he shows how certain markets, like stocks on daily timeframes, can exhibit that counter-trend behavior.
Where weaker stocks can outperform.
On the upside,
That's right.
this deep dive has been a revelation.
It has been fascinating.
Fishin's book is packed with practical insights and really challenges those deeply ingrained trading beliefs.
I agree.
But as we move into this final part of our deep dive, let's shift our focus to those alternative money management techniques that you mentioned.
Yeah.
The ones that incorporate machine learning and behavioral finance.
Sounds good. I'm excited to explore those areas.
Me too. It's all about pushing the boundaries and finding what works best for you, right?
Exactly. As we wrap up this part, I want you to consider this. How can we leverage these cutting-edge techniques to enhance our systems and navigate those ever-changing complexities of the markets?
It's a question worth pondering.
It is.
We'll delve into those exciting possibilities in the final segment, so stay tuned. All right, so we spent the last couple parts really getting into the details of building these reliable trading systems.
Yeah.
We challenged some myths, explored some specific techniques from building reliable trading systems. Now, I want to push the boundaries a bit.
Okay.
You hinted at some alternative money management approaches, specifically ones that incorporate machine learning and behavioral finance. Let's go there.
I'm glad you brought those up. Fishin's book focuses on more traditional money management, which is a great foundation. But the landscape is evolving rapidly, and these alternative approaches, they offer some really intriguing possibilities.
Machine learning, for example, seems to be everywhere these days.
It does.
What makes it so powerful for traders specifically?
Well, imagine, being able to analyze these massive amounts of market data way beyond what a human could process.
Yeah.
And identify those subtle patterns, those correlations that we might completely miss. That's what machine learning excels at.
Right.
It's like having a super-powered research assistant who's crunching numbers 24/7, uncovering hidden insights.
It sounds almost too good to be true.
It does.
Are there any downsides or challenges to consider?
There are. One of the biggest is something we've already discussed, curve fitting.
Right.
Just like with traditional systems, if you're not careful, you can train a machine learning model to perform flawlessly on historical data, only to have it completely fail in live trading.
It's that garbage in, garbage out.
Exactly.
If you feed the model bad data, you're setting yourself up for failure.
Precisely. You need to be incredibly rigorous with your data selection, testing, and validation.
Okay, so machine learning is about analyzing data and uncovering patterns.
Yeah.
But what about the human element? That's where behavioral finance comes in, right?
Right. Behavioral finance recognizes that we're not always rational actors, especially when it comes to money.
Right.
Emotions like fear and greed.
Oh, yeah.
They can cloud our judgment and lead us to make bad decisions.
I've been there.
Right.
So how can we use those principles to actually improve our money management?
Well, one approach is to design systems that account for our biases.
Okay.
For example, you might build in safeguards to prevent you from chasing losses or getting overconfident during a winning streak.
So it's about recognizing your weaknesses.
Yes.
Creating structure to mitigate those impulses.
It's like having that angel on your shoulder.
Yeah, whispering words of caution when you're about to do something reckless.
Exactly. Another practical application is sentiment analysis.
Sentiment analysis, okay.
Imagine tapping into the collective mood of the market.
Wow.
Gauging how other traders are feeling. Using that to inform your decisions.
That sounds incredible, but how do you even measure something like market sentiment?
There are a number of techniques. Some involve analyzing news articles, social media posts, other sources of commentary to gauge the tone, the overall sentiment. Others use more quantitative approaches, tracking things like put-call ratios or the VIX.
So you're combining those qualitative and quantitative approaches to get a more holistic view of market psychology?
Exactly. It's just one piece of the puzzle. but I think it has the potential to be an incredibly powerful tool.
Especially when combined with those more traditional approaches that we talked about.
Right.
Okay, we've covered a lot of ground today.
We have.
From those fundamental principles of tradability
Yeah.
to these cutting-edge techniques using machine learning and behavioral finance.
It's been quite a journey.
What are your final thoughts for our listener, those key takeaways they can apply to their own trading?
Well, first and foremost, I think Fitchin's book, Building Reliable Trading Systems, is a must-read. It's a solid framework, a blueprint.
Ah, great starting point.
Exactly. But the real magic happens when you start exploring those alternative approaches, pushing the boundaries. Don't be afraid to experiment.
Challenge the conventional wisdom.
Find what works best for you.
That's the beauty of trading.
It is.
It's a constant journey.
Absolutely.
Learning, adapting, self-discovery.
Got it.
There's no one-size-fits-all solution,
Nope,
which makes it so challenging and so rewarding.
it does.
So, to our listener, I encourage you, dive deep into Fitchin's book, really absorb those insights, and then start exploring.
Yeah, push those boundaries.
Who knows what incredible discoveries you'll make along the way.
Exactly. Embrace that curiosity, never stop learning, and remember the most important lessons are often learned not from our successes, but from our mistakes.
It's about failing forward.
That's it.
Coming back stronger.
Absolutely.
This has been an incredible deep dive into building reliable trading systems.
It has.
It's a book that can really transform your trading,
It's
but only if you're willing to put in the work.
Mhm.
Challenge your assumptions.
Never stop learning.
Happy trading, everyone!